Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
Okay, so when you first start trading options, because as I mentioned, most traders approach options after having a little bit of a background in some other type of trading vehicle, future, security, or currency. And you're probably pretty comfortable with the directional aspect of options. You heard someone say, hey, why are you buying these currencies? You could buy a call and you can get so much more leverage. Or, why are you buying the currency, when instead you could buy a put alongside it and protect it, or you could do a covered call with it and and do all these things, and most of these things are sort of revolve around directional trading. It's very natural for us to think about trading directionally, but I'm kind of spending a lot of time on this only because there's more to options than direction. We're going to start here, though. Let's say you're looking here at the AUX. Are you guys familiar with the AUX? That's the Australian dollar. That's U.S. dollars per Australian dollars. U.S. dollars over Australian dollars, right? So if the AUX is trading at 108.90, we can look at an option chain, and I selected this option chain here. Any option-friendly broker will be able to provide you with this, certainly. And we're just looking at the calls here. Now, options trade much like stocks, where there's a bid and an ask, and here we have a $1.33 bid at a $1.45 offer. Okay, so here's kind of the question. If AUX goes up by 1 full point from 108.90 to 109.90, how much are we going to make in our calls? Well, that's a good question. Now, it's kind of intuitive. It's kind of intuitive to think, well, obviously if the call goes up, or if the currency goes up, I make money on my calls, but exactly how much? Probably the answer is not exactly what you think. Now, here's how we answer this question. We need to look at the options delta. Delta is the rate of change of an option price relative to a change in the underlying currency. Okay, so now for those of you who are taking notes, these are the pages here that are important. These are the things that it's pretty darn important to write down. Okay. So if we look at, say, the 109 strike calls, that, again, are a $1.33 bid at a $1.45, we see that the delta is 0.4970. Wow, with all these numbers on the page, and we've got several decimal places out. If you've never looked at this before and you're not familiar with this, it could look a little bit intimidating. But it's really not. All this is the percentage that the option price will change given a change in the underlying currency. So this 0.4970, that's 49.7%. So the idea is if AUX goes up, if AUX goes up by 1 full point from 108.90 to 109.90, we'll see the price of the 109 calls go up 49.7%, or about 50% in value. Or, 50% of the move of the underlying. So if the underlying rises by $1, we see the calls rise by 50 cents. Now, I chose to kind of do this in a sort of non-academic way, and I wanted to, kind of let the rubber hit the road here and actually use a real a real option chain with a real example to make it realistic. Because if you do this very, very simply, and just put a single number on the page, you go there tomorrow and you're like, oh man, what was that guy talking about? It all looks so neat and clean on his pretty little slides. But looking at this option chain, if you really start thinking about exactly what this means, if AUX goes up from 109.90, and I'm telling you that the price of the 109 call is going to go up by 50% of that, or in this case, 50 cents. What price? What does that mean, really? Look at this. It's 133 bid at 145. I mean, arguably we can kind of be a little philosophical here and say, well, what's the price of this option? Is it 133? Is it 145? Is it something else? Well, you need to kind of think about that, because if you're making trades, you're likely to be selling on the bid or buying on the offer, at least pretty darn close, unless you're doing a spread. So here's how you think about this. When I was a market maker on the floor, I would look at what I would call a theoretical value or fair value. And that's a number pretty much smack dab in the middle here of the bid and the ask. So let's see, 145 minus 133 is 12, half of 12 is 6, so about 139 is fair value. So, okay, so if AUX rises by $1 and the call has about a 50 delta, right, then the call will rise by about 50 cents, so it'll go from 1.39 to 1.89 for fair value. And then we know the bid's going to be a little lower than 189, and the offer is going to be a little higher than 189. So that's kind of one way to look at it. And the other way is quite simply, if you're a seller, you know you're going to be probably selling the bid or around the bid. You can just look at that as the value as well. You can say, okay, well, right now the bid's $1.33. If AUX is 1 full point higher, then I anticipate the call being about 183 bid. And I can make the same justification for the offer if I'm a buyer. Hey, if it's at 145 now, if it goes higher and I want to buy, I'm going to have to buy at 195. And the same thing if it goes lower. That delta, again, is the percentage that the option moves based on a movement in the underlying currency. So if the currency goes down, the call's likely to go down also. If AUX goes down to 107.90, then the price of these calls are going to go down by 50 cents, 50% of that move. So that would be about 83-cent bid at 95 cents. See how that works? So, okay, now, why do we care about this? Well, because this is the most important thing you need in your decision-making process. A lot of people draw P&L diagrams. In my book, I don't call them P&L diagrams. Profit and loss is what P&L stands for. I call them at expiration diagrams. Why? Because they're diagrams of the profitability at expiration. Those diagrams only matter if you hold the option all the way until expiration. If you're buying a call and holding until expiration, you're doing something dreadfully wrong. And you're not going to last very long as a trader. A lot of strategies are short-term strategies. You hold it for a couple days, maybe a couple weeks. Even some of the strategies like income-generating strategies that are generally longer-term strategies that you have to hold nearly to term, you're almost always going to close those out before expiration when the risk-reward isn't there anymore. So those diagrams they're pretty useful, but they're not nearly as useful as the Greeks for trying to understand, hey, if this happens, this is how much I'm going to make or lose.
To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.